Welcome back, and joining me to take us through the day's trade is Nesi Chetty from Stanlib. Nesi, thanks so much for joining us today. Now, a relief rally taking hold of markets today with most, if not all, equities in the green. The JSE also joining in there, ending the day on an upbeat note. Nesi, what have you made of markets action, and do you think that the global sell-off that hit us on Monday was a bit over-exaggerated?
Yeah, good evening to you and your viewers. I think it's definitely been a volatile week for markets. We saw at the start of the week the big sell-off in the Japanese Nikkei. And just to put that into perspective, the fall we had on Monday, I mean, was the single largest decline we've seen in that stock market. You need to go back to Black Monday in 1987 to see a similar 13% fall. So you're right. I mean, a little bit of overreaction in that market. But I think there's two things important impacting markets. We saw the unwind of the yen carry trade. So that's investors borrowing cheaply in yen to buy other risk assets in other hard currencies. But I mean, the hiking from the Bank of Japan has resulted in some reversal of that. So you would have seen the yen appreciate over the last week. But it has spilled over, I guess, into other markets as well, like the US, where we saw the tech shares come off on the back of recession concerns again. But you've had a bit of a relief rally in the market today.
So, you know, with economic risks still at play, Nesi, that cooling labor market, we're also getting the initial jobless claims tomorrow. Are we pegging in an even higher rate cut from the Fed come September?
Yeah, look, it's a little bit twofold. I mean, there was a lot of noise around that the Fed's comments last week. I mean, if one looked at the Fed's comments, the actual statement was neutral, but the Q&A was fairly dovish. I think the uneasiness in the labor market will still persist, and even today, as investors reset expectations, we're still seeing, I mean, that unemployment rate that's jumped to about 4.3%, and it's moved higher in recent months. While unemployment rate of 4.3% by historical standards, it's still low. The risk is that the pronounced weakness you're seeing in the labor market could become self-fulfilling as companies worry about their cost base and they need to reduce, I guess, overall levels of employment. So the Fed is watching that. I think the recession noises regarding that, they'll need to relook probably interest rates maybe being cut a little bit more aggressively over the next 3 meetings.
All right, let's get into some company news. The JSE released interim earnings, revenue up about 4%. HEPS, however, flat, down 0.2%. The half-year period, Nesi, was characterized by a lot of uncertainty and volatility as it was ahead of the formation of the GNU. With that being said, was the subdued performance expected?
Yeah, look, if I look at overall trading activity and we look at volumes in that equity market, trading activity would have been down about 12%. So it was a challenging economic environment for the JSE. That said, they grew their revenue about 4.3%, and they were able to maintain their net margins around 2.1%. There is a benefit of having diversification across some of their asset classes where they do get a benefit. And I guess there's also been progress in growing their non-trading revenue. So the value traded, I guess, in the South African equity market would have recovered in Q2, leading into that GNU news. And I guess the trend is probably extending into the months of July and August as well. The other thing is that I guess if I look at their performance, they grew their expenses around 6%, which is quite pleasing. And the balance sheet is still very strong, with they're sitting about 1.8 billion cash.
All right, let's move over to Quilter, the wealth management group, posting a 28% jump in profits, benefiting from strong flows and cost savings initiatives. Your analysis on those numbers?
Yeah, look, they had a very big uplift in their core net inflows to about 1.7 billion pounds, and their adjusted profits were also up quite nicely, about 28%. I guess they have had the benefit of very strong channel flows across their business. So increased platform IFA flows did very well over that period. But what you also saw, I guess, in their numbers is asset retention strong across most of their channels. So their total assets under management grew quite nicely to about 114 billion pounds. But what you're seeing in that market, I guess, is strong growth in high net worth and the affluent segment as well. So that's seeing good growth and good margin. they did have a little bit of cost savings as well, 26 million pounds. So overall, a good result, and they did pay an interim dividend as well.
Yeah, very good result considering that they are operating in the UK and that economy has had issues of its own, Nesi. Let's move over to the mining sector. Glencore also out with numbers, not looking good. It's EBITDA tumbling. But I guess the big news here is that the miner has decided to hold on to its coal assets. Your thoughts on that move, considering that, you know, we are moving into a greener world?
Yeah, look, I mean, it was the half-year report, and the board did do a strategic review, and they didn't necessarily, I mean, they did canvass shareholders in terms of their support and preference, but after that strategic review, they decided to retain their coal and carbon steel business, as opposed to looking at maybe a demerger. I guess if one looks at it longer term, I mean, by retaining those assets, they will enhance Glencore's cash flow and cash generating capability, and they could potentially look to fund that in opportunities in other areas like their transition metals portfolio. So I guess this result, one must take it against a backdrop of lower average prices across a lot of their key commodities. But overall, I mean, the key metrics look okay. I mean, the net debt to EBITDA did come down over the period. Thermal coal was up to about 6.3 billion on an EBITDA basis. And their margins also held up, I guess, in metal operations and energy at about 31%. If one looks at debt, I mean, they only need to come down about $300 million to reach their 10 billion debt cap.
So, Nesi, the mining sector, not one you're seeing value in at the moment, but you are seeing value in the property sector. What's your stock pick?
Yeah, our stock pick is Vukile. I mean, if we look at the current Vukile portfolio, it's got two distinct operating segments which are growing quite nicely. The company has good exposure to the SA low-end consumer retail market. That's about a 16 billion portfolio, and they generate net operating income of about 1.3 billion. So that's a very attractive yield for us at 8.7%. It's strategically handpicked properties across the township, rural, and urban segments. Even if we look at vacancies there, I mean, township vacancies are ultra low at about 1.4, while the commuter sector is 2.6. I think in a GNU recovery where we can get growth back into the SA market, these SA properties will do well. I think you've got the added bonus in Vukile that you've also got a very attractive Spanish portfolio, which is sitting at about 1.2 billion euros and a yield of 6.6. And that market's growing. You're starting to see trading densities pick up. In SA and Spain, they've had positive reversions in that market. This is a company where we think there's a benefit likely of revaluations as interest rates come down. It's been one of the few companies in the property market that's been able to successfully do a capital raise year to date to fund acquisitions and pay down debt. It's on a forward yield of close to about 8 and at a discount to NAV of about 30. So we like it longer term in our funds.
Alrighty, so Vukile, one to look out for. Nesi, thanks so much for joining us and just taking us through the day's markets action. That was Nesi Chetty from Stanlib.